So welcome. My name is Christy Mora, and I'm on the team here at Generis. And welcome to the Employee Retention Credit Information Session. Leading our session today is Jim Shepard. He's Principal and CEO here at Generis. And joining us is Chris Purnell, Tax Counsel and Partner at CapinCrouse. So we're delighted to have him here. Thank you so much for joining us. And before we get started, and I pass this over to Chris and Jim to help us out with this ERC, I'm going to get started. I'm going to kick us off with some housekeeping. So this webinar will be recorded. We are currently recording, so we'll share a copy of this recording with you in a follow-up email, likely by tomorrow. This will be such a great resource for you to share with your team. After the presentation, we will move into a Q&A session. So starting now, you are welcome to drop in your questions in the Q&A feature, and we'll get to those at the end of our discussion, and just to help you out where you need it. And the chat is available right now. So if you want to go ahead and let us know who you are and where you're tuning in from, that would be awesome. All right, Jim, Chris, I will let you both take it away from here.
Christy, thank you so much. And Chris, welcome, welcome, welcome. Thank you for joining us today. CapinCrouse are great friends of ours, and good to have you here with us today as a kind of an expert on the topic that we're talking about here. So thanks for joining.
Glad to be here.
Hey, so let me just say a word to everybody who's there, Chris. You and I are going to kind of dive in, and we're just going to make this a conversation. We're not going to do a slide presentation or anything like that, because I don't think it really calls for that. I think we can do everything we need to do. Kind of just going through some questions that you and I have talked about. But what I want everybody to understand, what really kind of motivated us to do this webinar today. And I think it's just this anecdotal sense that there are lots and lots of churches out there that either A, weren't aware of the employee retention credit, or B, had heard about it and either thought they didn't qualify or that the deadline had passed. So what we hope you come away with today is an understanding of, if you haven't applied for employee retention credit, there's a really good chance that you have left some significant money out there that belongs to you. Think of it as you just discovered a bank account that belongs to your church or ministry organization that has some money in it, and all you have to do is apply and get it. Now, here's a really important distinction, because there are some churches that when the original CARES Act came out, and then of course the CAA, that Consolidated Appropriations Act that extended it for another year. When PPP originally came out, there were a number of churches that took the position that this represents government assistance and we're not interested in that. Totally understand that, get that. You know, even my own church had that same kind of position. Hey, look, you know, we get it. There are lots of churches that can use this. We really don't need this. However, employee retention credit is completely different from that. Basically, what the government is saying is, if you meet these criteria, which we'll go over in just 2 minutes, even just one of these criteria, we have effectively reduced the employer tax rate that you paid on those people during this time frame, and we are making a refund of employment taxes that you have paid available back to you. So it's not government assistance per se, it is a refund of employment taxes that you have already paid. So if you're here today and you're thinking, well, gosh, I don't want government assistance, this is different than that. And even my church, which was not in favor of PPP, has filed for employee retention credit. So important distinction there, because I know that there are some, and we totally respect the views of those who saw it that way, but want to kind of dispel that notion here on the front side. So with that, let's dive in and let's see if we can kind of light this up for you and get your attention, because they're probably, my guess is many of you on this call probably have some ERC money available. And let me just go all the way to the end, Chris, real quick, so that everybody can relax. We don't have a call to action at the end where we're looking for you to contract with us or with CapinCrouse. This is our gift to you. Generis and CapinCrouse are giving you this gift here today of helping you to understand how you might recover these funds that the government is willing to give back to you if you'll just file a few notifications and get that done. So let's do this. Hey, Chris, let's just start off. You know, Vince Lombardi used to start off the Green Bay Packers back in the day with the, remember, what is a football? Let's get to the basics. What is the employee retention credit? Give us kind of an explanation on what this really involves.
Yeah, and I really wish, whenever I hear that anecdote about Vince Lombardi, I really wish I could have been there for one of those first,
right?
like, this is a football kind of moment.
This, gentlemen, this is a football. Every year.
You have to listen because the dude won so many Super Bowls. So you're like, okay, this guy knows his stuff.
Right.
Not that I'm Vince Lombardi by any stretch of the imagination, but the employee retention credit at its baseline level is a fully refundable payroll tax credit that is based upon qualified wages paid during an eligibility period. Now, there's a lot there, but at its base essence, like Jim mentioned, you're taking an employee payroll tax obligation form, the 941, and you're saying, this is how much we paid to folks during the time frame we were eligible for the credit. And we can talk about that too. And because of those wages paid during that time frame, we are eligible for a credit based upon those qualified wages. To kind of point back to something that Jim noted before, the wonder of this credit is that it's fully refundable. Most tax credits are not fully refundable, meaning that they get credited against some particular aspect of taxes that you've already paid. With a payroll tax credit, usually it's credited against the employer's portion of the Social Security tax or the Medicare tax or something like that. And that is the beginning of the employee retention credit, where it's credited first against the amount that you paid as an employer based upon the wages that you pay to your employees. But then it goes above and beyond that. It's fully refundable, which means that the rest gets sent back to you as a claim in the form of a check. Now, you have the option of having it credited to future quarters' payroll tax obligations. I have had precisely 0 clients decide to go ahead and apply it to future payroll tax obligations. The cash in hand is very nice. But here's the thing. There's a lot to note here. But the first thing is it's a fully refundable payroll tax credit. The second thing is that it's based upon qualified wages. And the way that the credit talks about qualified wages is that it's a per employee maximum. So the per employee maximum for 2020, the entire year, is $10,000 per employee. That's your qualified wages bucket for the employee retention credit. In 2021, that amount stays at $10,000, but instead of $10,000 for the entire year for employees, per employee, it's $10,000 per quarter per employee. The credit, it runs from March of 2020 through September of 2021. So you got a nice long period of potential eligibility for the credit. But the qualified wages amount, again, $10,000 per employee in 2020, the entire year, $10,000 per employee per quarter in 2021. And then the credit itself, for 2020, it's 50% of qualified wages. And then for 2021, it's 70% of qualified wages. So that's the qualified wages part of that definition. And then the last part is during your eligibility timeframe. So the way that you measure that is you've got 2 pathways. And I know we'll kind of dig into the weeds a little bit with this, but I just want to throw it all out there and see what sticks. But the first pathway is they experienced a significant decline in gross receipts from a quarter in 2020 versus that same quarter in 2019, or a quarter in 2021 versus that same quarter in 2019 as well. So that's the first pathway to eligibility. The second pathway, which I'm sure we will talk a lot about, is the fact that you experience some kind of suspension of your services due to a governmental order related to COVID-19. And that's where, by and large, most of my clients have been able to get access to the credit is through that particular pathway to eligibility. And we'll talk more about that. But at its baseline essence, it's a fully refundable tax credit based upon qualified wages paid during your eligibility timeframe.
Chris, man, you just teed up a bunch of conversation there. We'll dive into that. But let's start here. Why do you think there's so much confusion among churches and ministry organizations and nonprofit orgs about their eligibility for ERC?
Yeah, I think there's probably 3 or 4 reasons. The first one that I think of is at its beginning, when the Employee Retention Credit was created by the CARES Act. It was created alongside the PPP loan program. Right. And at that point in time, you had to choose. You had to choose your adventure. Do you want to go down the PPP loan route, or do you want to go down the ERC route? Many clients, in fact, many churches decided to go down the PPP loan route because it was this finite amount of funding, and it was that kind of limited time offer. You got to get in the door now because the funds are disappearing. And the ERC was just opaque enough that people were like, I don't know if I really understand that, and I don't really know if we're eligible for that. And so I think most folks went with a PPP loan. Well, then of course in December of 2020, with some legislation by Congress, they decided to open it back up to those that received a PPP loan, and so you can go back and retroactively claim it. I think that there's probably some folks out there that think, gosh, is this available to nonprofits generally? Is this available to faith-based organizations? Is it available to churches? Certainly lots to think about there. The one big thing that I think some churches thought was, gosh, this requires a significant decline in gross receipts, which is 50% in 2020, a 50% decline, which if you had a 50% decline in gross receipts in 2020, brother, you're probably not sitting here on this webinar talking to me about the ERC.
No, you're doing other things.
That's right. You're packing up shop. So
that's right.
The decline in gross receipts was so catastrophic in 2020 that it made many people think, okay, well, that's the only eligibility pathway. We're done. Now it gets a little bit better in 2021 because the decline is only 20%, but still that's fairly significant. So I think most people sort of wrote themselves out of the picture when they saw the significant decline in gross receipts. I think the other thing is that when you start sort of pressing into the calculation of the credit, the eligibility timeframe, those questions can become a little bit nuanced. And when you start digging into the IRS notices, Jim, I mean, these things are like 105 pages in Notice 2021-20, 2021-23, 2021-49. Like these are gigantic documents. And so I think a lot of folks were like, I'm out. This seems like it's way too complex, and so therefore it's not user friendly. I can't do this. So I think that's part of it. And then the last thing, the fourth reason, is there are a lot of companies that are out there that are happy to help you with this credit. And I think sometimes their sales tactics can get a little aggressive for some organizations. And so they think to themselves, gosh, if this kind of aggressive company is trying to sell me this credit so that way they can take a chunk of it, it almost leads to this ironic thing where you're like, well, I trust the credit less because these folks are trying to sell me on it so much. Because I think that's something I've heard from clients in the past is that it just doesn't seem right, Jim. A free lunch, our mamas and our papas always told us that there's no such thing as a free lunch, right? And so this doesn't seem quite legit, but it is legit. It really is.
That's right. Yeah. And I think one of the things I have heard, Chris, is at your reference, there's a little cottage industry that has broken out on ERC recovery, right? That will do that for you. I think the predominant rate that I've seen is somewhere around 35%. I'm sure there's some that are charging less, some that are charging more, which means, if I get $100,000 in ERC, they're going to get $35,000. Well, that's why they're marketing it so hard.
Yeah.
And it gives the whole thing a bad reputation. I think what we would say to everyone here is, it doesn't have to be that complicated. If you don't have the answers internally, there's a real good chance that your accountant has that. And probably most of these churches, even if you don't have an audit every year, you probably are using an outside accounting service, and they can do that. Many of the payroll services actually have the ERC report embedded into their system, and you ask for the report and they can produce it for you. Insperity, Paychecks, ADP, I know those three for sure all have it embedded. So it's really easy to get it out of there. So what we would say is, I really want to dispel that notion that you don't have to go to this cottage industry and do business with them to get your ERC. You can do this on your own.
Yeah.
Then in support of your nobody believes in a free lunch, I had assumed, Chris, even when we set all this up, I thought, well, gosh, the largest churches in America, they know about this. Apparently I was wrong. I won't give anything away other than to say this church has in excess of $24 million annual income. They have over 80 full-time equivalents. So you can do the math in your head, Chris. You and I can both do the math. There's a lot of ERC sitting out there to be claimed. The person that I spoke to went to their financial department and said, there's no way that money is ours. No way. And of course, then he goes back and says, yeah, you might want to check a little further. And now they're applying for 24 million in income. 80 plus full-time equivalents, and they didn't believe it was even real. They just like, my grandma and papa told us, no such thing as a free lunch. Well, it's not exactly a free lunch because it's a return of money that you've paid in. It's an overpayment. It's not the same thing as, but think of it like on your personal income tax return. If you paid the IRS too much money last year, you get to, say, hey, I get my money back. Well, what you've done is you've overpaid the government because they've reduced the rate on employer taxes, assuming you meet one of these criteria. The 50% decrease, that's draconian. You're right. But you know who does fit into that? My friend Cliff, who runs a restaurant. Cliff runs a restaurant. He went way down, down. And he qualifies because he was under a government order, because in the state of Georgia, he couldn't have people in person in his restaurant. Well, he went in, to fast delivery, but even then he couldn't pivot fast enough and he took a big hit. So while for churches, that may not be the issue, as you point out, all you have to have happen is that whole idea of, were you subject to a government order that suspended services? Boom, now you're in there. Now you're in there. Okay, so let's dive. Let's get a little technical here for a second. So, I know there's lots of details and we don't want to go all the way down in the weeds, but what's 2 or 3 really important things that they would need to be on the lookout when doing the calculations, assuming you're a church, you're a nonprofit organization, or some kind of a private Christian school or ministry organization like that?
Yeah. So there's some really interesting wrinkles when it comes to churches and organizations that employ ministers. So one of the things that is noted in Notice 2021-20 and in the original FAQs is that ministerial wages, so wages paid to ministers who are ordained, commissioned, or licensed and receive a housing allowance, those are not technically wages for the purposes of the ERC. And I think that's a really key exclusion. And initially when that happened, we were like, well, is that because they pay the SECA tax, right? Ministers, they pay that amount outside of the amount that the employer takes and then contributes on the employee's behalf. And that was the theory initially, but then in the Consolidated Appropriations Act back in March of 2021, Congress came through and said, well, so we're going to throw back in these other FICA exempt employees. So the biggest one was students, but they decided not to throw in ministerial wages. They explicitly excluded ministerial wages at that point. And so I don't know what to kind of toss that up to. I don't want to get in trouble for besmirching any political parties or anything like that. But at the same time, it just makes you wonder how strong was the college and university block versus the church block at that point in time. But that's one big exclusion. If you've got ministers on staff, which as a church you almost certainly do, who is ordained, commissioned, or licensed and being paid for ministerial services, then those folks' wages should not be included. Now, there is a colorable argument to be made, but it's more of an argument from silence that maybe you could include their qualified health plan expenses. But for something like that, I would recommend that you certainly talk to your accountant or your legal counsel before you do something like that. That's one big important thing when it comes to the calculation of the credit. The other thing, if you are a church who decided to go the PPP loan route, just know that whatever payroll costs that you use to obtain full forgiveness of your PPP loan, those payroll costs cannot be used as qualified wages for the ERC. Congress and the IRS, they decided that that's one bucket of wages, which is true. So what I recommend is taking a look at your payroll covered period for your PPP loan. And then if it happens to coincide with your ERC eligibility timeframe, then just know that you can't use the same payroll costs that you needed to use to obtain full forgiveness of your PPP loan as qualified wages for the ERC. There are several different ways to move around that. And again, please talk to your accountant, please talk to your legal counsel, feel free to reach out, and I'm happy to chat about that. The third thing to talk through that I think is really important is whenever you're going to actually file and claim the credit, and I don't know if I'm jumping too far ahead, Jim, but
go right ahead. Go right ahead. You're good here. You're good here.
When you're going to file and claim your credit, as Jim mentioned, many payroll companies, they offer some kind of suite of services where you just input information and they kind of spit out the 941X and that sort of stuff. But some payroll companies are being a little bit squirrely when it comes to folks claiming the credit. And this usually arises when your PEO, your payroll company, they're the ones that are filing your 941s, but they're filing underneath their EIN.
Right.
And they've got a group of folks that they're filing the 941s for. And so they've got a group of folks who might be coming back and saying, hey, can you file a 940X for me? Can you file a 940X for me? Well, that requires them to file one for the entire operation. And so I've noticed that several of those big players, the ADPs, the Paycoms, the Paychecks, they are very reluctant to file 941Xs for the ERC. And it's problematic. There have been times when I've had clients say, well, then I just need to leave because, for them, it's $100,000 or more, which for their shop is life-changing. And so they have to leave their payroll company in order to do that. So just know that there could be some dynamics there with your payroll company when it comes to actually filing the amendment to the prior quarter payroll tax filing.
Yeah, good stuff, Chris. That's so good because there's so many things in there. We've got some questions, and at the end, we'll kind of come back and answer a few of the more granular questions because I think they're diving in on some of the things that you're addressing right here. So let's ask a big picture question here. So if I'm sitting there and I'm in the finance seat in my church, is there any reason, or ministry organization or private school, is there a reason why I wouldn't file for the ERC? Anything comes up there?
Well, aside from the very obvious one, like you're not eligible for the credit. No, there's really no reason.
Yeah.
And here's the thing. What I tell our clients is that if the IRS comes and audits your claim of the credit, which the IRS has sort of amped up its enforcement power here. So usually the IRS has 3 years to audit claims that are from payroll tax filings. It's now giving itself 5 years from the time frame that you send in a 941X. And I think it's doing that for 2 reasons, Jim. The first one is, and you guys as folks who have filed for this credit, you get this. These checks are not quick in the coming. They're taking about, depending on the size of the check, they could take anywhere from 3 months on the very short end to a little bit more than a year on the long end. My suspicion is we got some smaller organizations on the call. So if you're looking at a credit sub $100,000, then you're probably looking closer to that 3 to 6 month time frame.
Right.
But still, the IRS is sending on millions of unprocessed 941s and 941Xs. And so I think the IRS understood it's going to take us a while to get through these. So we got to give ourselves more time. The second thing is, chronic hiring issues, just like the rest of the country is facing. You've got Long John Silver's and the IRS dealing with the same stuff, right? Where everyone's just wrestling with finding the right people. And then the third thing is, this is a space that I think the IRS understands is going to be rife with fraud implications. Because whenever you claim the credit, you're sending a 941X, which is a 3 or 4 page form, and that's it. You don't send in any kind of corresponding documentation. There's no front end vetting that really happens. So you're sending this document in, and then the check arrives. And there has never been a situation that I've been a part of where you send in a 941X and the check doesn't arrive, which means that it's kind of automatic once you file.
Yep.
And so the IRS is going to start using the audit process to audit those claims of the credit. We don't really know exactly how much of an audit risk this is going to be. And I mean that in the purest sense of the term. We just don't really know. But my suspicion is, given what the IRS has done in the past, there's going to be some kind of threshold amount that the IRS will, in its esteemed wisdom, will choose as a more likely than not. And then there may be some industries that the IRS looks at and says, well, this industry, the ERC was kind of built for this industry. Jim, you mentioned the restaurant industry earlier. The ERC, it fits like a hand in glove. That's right. With the restaurant industry. If you have any kind of group gatherings, hello church, that is something that the ERC was really meant for. Because if you think about the governmental orders that were happening at that point in time, it was a lot of social distancing guidelines, a lot of occupancy limitations. And so think entertainment venues, think things that require the gathering of people in any form or fashion. So I think those may get a little bit less of a look. But at the end of the day, we're not entirely sure what this is going to look like. So we really recommend that you create some kind of narrative that establishes, here's what we decided to do. And I may be getting a little far afield again. Just rein me in, Jim.
I love this. I love this because this is what I would recommend too. I love where you're going with this.
Awesome. If you can establish a timeline for what kinds of modifications you made to your services, and did you go fully remote? Did you have online church? Did you reduce the occupancy of your sanctuary from, obviously 100% to 50% or 25%, something like that? And then establishing a timeline. How long did that last? And what kind of impact did that have on your trade or business? As a church, we all understand that video church, Zoom church, whatever you want to call it, it just was not the same as being physically present with each other. God made us with bodies for a reason.
Yeah.
And so you can make, I think, a really good argument there for saying that that was a limitation on your trade or business. And then matching that up with the governmental order or governmental orders that may have been in play at that point in time, I think is also really important. And so downloading those off the internet, keeping them safe and secure in some electronic file. So that way, hopefully, it is one of those hidden masterpieces, like Emily Dickinson's poems that just sits in some drawer somewhere and never sees the light of day, right? Because if it's coming out because the IRS is calling.
That's right. That's right. That's right.
So we really recommend that there be strong back-end documentation to substantiate your claim of the credit as to why you experienced the partial suspension of services due to the governmental order during the time frame you're claiming the credit.
Yeah, I love that idea, Chris, of just creating a work paper file that has both your assumptions, both the documentation from the government, and then has your computations with any explanations that you need in there, so that when they come back, you can walk them through what you decided in an orderly fashion.
That's right.
I think you and I both know, and we don't mean this as absolute counsel and guidance, but generally speaking, the IRS doesn't take an aggressive view as it relates to penalties and other things when they can see that you had a clear thought process that might have been off a little bit. And they might just, if there was something, you'd get off pretty easy, as opposed to, hey, look, we don't have that documentation. We just kind of, and they're going to make you go back through it. And they're going to take a very dim view of that, that you were just kind of throwing some dice out there and you came up with a number and this is what you filed for, as opposed to, we had a really carefully thought through process that, as best we understood it at the time, adhered to the guidelines. The IRS is not going to take a terribly aggressive standpoint. Again, you'll owe the additional taxes and maybe a little bit of interest, but it's not going to be like the other. So I want to really put a big exclamation on that, Chris. You can put it in a Dropbox file or something electronic where you just labeled, ERC work papers, and you have all your documents right there. IRS comes calling, you go right over there. And if they don't, like you say, they just never saw the light of day because they didn't need to.
Amen. And church turnover, right? It's a thing. And so if you're looking at a 5-year timeline where the IRS could potentially come calling, just having that available for someone who, may get the letter in the mail from the IRS and they're like, what in the world is the employee retention credit? And I don't even have the faintest idea of what that thing is. Having that documentation is not only going to be helpful for the IRS, but also for that person who's going to be communicating with the IRS about the ERC.
Yeah,
so
exactly.
It's very important.
Well, and my guess, again, this is going to be my guess, you alluded to this, when they came out with the PPP, initially they said that, certain applications would be audited, and then they came back and amended that later on and said, if your PPP was $2 million or more, you would be examined. Now, I don't know that 2 million is the number here, but I think that you and I would probably agree there's some threshold, whether they say it or not, at which there's either going to be 100% or a much higher incidence of review, and it's probably based on amount. So if you're a larger church out there, like my friends at the one that I referenced that had no idea about it, I would urge you to be very careful in your computations and very careful in your documentation as to how you came up to that amount, because there's a real good chance they are going to call on you and you'll want to pull that file out.
Agreed.
All right, we're going to dive into some Q&A here in a second, but before I do, one last very broad question. Chris, anything you want to say to the folks who are in? We've got a great crowd on here this afternoon. Anything just in general you would say to them before we dive into some specific questions?
So generally, I would say that the ERC is one of those credits that seems too good to be true, but if you are eligible for it, it is a significant boon. Many churches faced financial struggle, but many of them didn't. The Lord really provided for them during that time. And the way the credit is meant to operate is it's meant to both incentivize you to keep your employees on. And so if you did that during a time of really great uncertainty, which the last year and a half has really fit that bill, then the ERC really is something that you should explore. It's the way that I would put it at the end of the day is that it really doesn't hurt you much if you explore it, right? You may have wasted just a little bit of time, but the time was not wasted. In fact, it's something that is so important and can be such a boon that if you spend a couple of hours investigating it, it will really pay out.
Yeah, love that. That's great counsel there. Great counsel there. Hey, I got a couple of them that I'm going to just hit really quickly because they came in and I think we've answered it somewhere along the way, but I just want to make sure that they hear that. Someone asked, how does the clergy housing allowance and ministers who have opted out of Social Security impact the actual amount of eligibility? And Chris referenced that just a little while ago. So when you get the replay of this, you can go back and listen to the explanation there, and or you can dive into the codes, because that is one of the issues that you'll need to be very careful with when you're doing your computation. Another person says, it seems the bottom line is that you had to have had a certain percentage loss in income in order to file. Correct. That's one of the misperceptions that we're here to dispel today. There are two pathways. You do not, it's not a both and, it's an either or. The percentage loss in income is one pathway. Most churches, as Kristen pointed out, if you had more than a 50% loss, 25% last year, you're probably not here on this webinar today listening to getting your ERC money back. You probably have already done something that impacted that, like cut staff and whatnot. So that's where a lot of people have missed it. They thought they had to qualify for the percentage decrease. There's this other requirement that says, did the government impose regulations, and all this list of things, which is easy to get online. I think it might even be in the resources that we're sending you after the fact. There's another list, and all you have to do is any one of those, you're like, yes. And most churches had their gatherings restricted. And once you see that, you're like, yes, it doesn't matter what your income did. You know, my church, I think our income was pretty much flat year over year, but we were subject to that and we were able to go back and get the ERC, even though our income didn't get hit hard. The restaurant guys are probably going to qualify under the percentage decrease in income. So there's an either or pathway. I want to make sure you hear that today. It's not a both and, it's either income reduction or these other conditions over here. That helps you out there. So let's go back. We got some great ones here, Chris. My organization qualifies based upon revenues for ERC in 2021, quarter 1 and 2, but I use those payrolls to support PPP. You've referenced this, but I want to go back and cover this one. Can I then claim ERC for quarter 3, even if we don't qualify for reduced revenues for quarter 3?
Oh my goodness.
How about that for a deep diving down in the weeds?
We are diving in. Yeah, that's
Yes.
fun. This is some good stuff. Okay, so there's this little thing called the alternative quarter election that is available for gross receipts decline tests in 2021. So basically what the alternative quarter election says is you can choose which way you want to qualify for a particular quarter. So let's take Q3. Q3, for instance, the questioner stated that they didn't qualify via the gross receipts decline for Q3 of 2021, but they did for Q1 and Q2. Sounds good. But they're wondering if the PPP loan payroll costs are going to gobble up all of their ERC qualified wages, which very well could be the case, depending on how much, in payroll and that kind of stuff they had. As a side note, I'd recommend going back and seeing if there are any other ancillary qualified wages they may be able to take from Q1 and Q2, because my suspicion is there's going to be some left over. But I can talk a little more after I talk about the alternative quarter election. So the alternative quarter election tells you that if you want to claim Q3, you can either A, use the measurement of Q3 of 2021 gross receipts versus Q3 of 2019, the standard measurement, or you can use the standard measurement for the immediately preceding quarter. So you can use Q2 of 2021 versus Q2 of 2019. And if you qualified underneath the gross receipts decline for that quarter, then you can use the alternative quarter election for Q3 of 2021. Now, the other thing you could do is see if in Q3 of 2021 you qualified under the second pathway, which is that partial suspension of services due to governmental orders test, because you don't need to have the same eligibility pathway for all quarters that you're qualifying for. You can sort of mix and match and add things together as you need to for each quarter. But the bottom line is, first off, investigate the alternative quarter election for Q3 of 2021. Number 2, see if you might qualify via the partial suspension of services due to governmental orders route for Q3 of 2021. And then lastly, go back through Q1 and Q2, because with the PPP loan program, you applied based upon 8 weeks of payroll costs, but your PPP loan covered period could be as long as 24 weeks. So you're going to have a lot more in payroll costs than you need to actually substantiate your forgiveness for the PPP loan. So I'd go back and investigate Q1 and Q2 as well.
Excellent, excellent explanation. All right, here's a great one. There's several of them that relate to this one, but this one really hits it specific. If you enter pathway 2, suspension of services due to government order, does the condition, the government order, need to be in place the entire period, March 20 through September 21, or do I just need a government order at any given time and then I can claim the entire period? There's several questions that relate to that, but that's the most specific one. It's a great question.
It is a great question. So the way that the IRS talks about your eligibility timeframe is it's the timeframe during which you have your partial suspension. So, you know, the occupancy limitations, the stoppage of work, the modifications to your services, and the fact that those had a more than nominal impact on your trade or business. So that time frame. So let's say that lasted from March of 2020 through the end of 2020, or maybe into the Q1 of 2021, something like that. And then you got the governmental order. So the governmental order, how long did it last? How long did it go for? Or the governmental orders, how long were they in effect? How long did they have authority over your operations? And then the degree to which those overlap, the partial suspension and the governmental orders, that's going to be your eligibility timeframe. And then your eligibility timeframe will end during as of the earlier date of either the suspension ending. So let's say you stop all your modifications or whatever the case may be, but the governmental orders go on. That's not usually what I see. Or the governmental orders end. The government comes out, the governor comes out and says, hey, I'm stopping all the restrictions on gatherings. I'm stopping all the restrictions as they relate to faith-based organizations or whatever the case may be. Each state was wildly different when it came to the employee retention credit. But the fact of the matter is that during that time frame when those two overlap, your suspension and the governmental orders, that's going to be your eligibility time frame during which you can claim the credit based upon qualified wages paid during that time.
That's such a good explanation. And so just a real simple way of looking at it, let's just say, and I don't know if I have this exactly right, in the state of Georgia, our governor started the restrictions roughly in March of 2020. And they came off in, I think, June 1st of 2021. So like a year ago today, right? So your eligibility period would have been March. And to your point, Chris, most of the churches, once the restrictions were lifted, they lifted their restrictions, right?
Yeah.
And went back, hey, yes, we're back. But if you had capacity limits and other things, then that might extend it from that. But if you just went by the government order, March through May, that would be your eligibility period, right? And so good explanation. I think there were a lot of people that were asking, clarity around that. Hey, so if I qualify in April of 20, can I claim it all the way through September of 21? Not exactly. You kind of need to be subject to the restrictions there. All right, let's get some others here because we've got a bunch of them. So let's see. I think you've just go back again. We received the PPP. Some of this was actually applied to wages. That's just qualifies from ERC and how is this calculated? You referenced that. Let's just kind of bypass that one because I think we're good there. Do local government mass days count as a qualifying event for full or partial shutdown? I think yes, whether it's state or local, that would apply, right?
That's right. That's right. The way the IRS notice talks about it, it has to be some kind of U.S. governmental order. So federal, state, or local. That's right.
Yeah. Yeah. Okay, so here's a good question. This is going to have some nuance to it, Chris. I'd love to hear your answer to this. I think I know where this goes, but can you explain what constitutes a change in operations? In March 2020, we no longer held services or meetings on campus. We were not told to do this by any government organization, but we did it on our own for health and precautionary reasons. What would be the case there?
This is a really sticky wicket, as they say. So
that's why I brought it up.
Because many churches did this. Many churches did this where they just wanted to be good neighbors. They wanted to make sure they weren't putting anyone at any undue risk.
That's right.
And so they voluntarily decided, you know what, we're just going to stop our place-based services. So the way the IRS talks about this is it would probably classify this as a voluntary suspension of services. So a voluntary suspension of services, it exists in one of two pathways or one of two scenarios. The first one is the one we just talked about, where an organization decides, you know what, we're just going to shut up shop. No governmental authorities telling us to do this, but we're just going to do it on our own. That's a voluntary suspension, and that would not qualify underneath the suspension of services test because there must be some kind of causation link. It doesn't have to be like we looked at the governmental order and we did everything because of the governmental order. But there must be some kind of connection between the governmental order itself and your actions that are suspension-ish in nature. So the other area where we see voluntary suspension is when customers decide not to come to that particular organization anymore. Maybe your people were just like, we're not going to show up. And then it forces you to stop having services. That also will not work. There's got to be that governmental order that exists and tells you, you shall do this or you shall not do that. And the kind of punchline that the IRS wants to see is, yes, but the governmental order tells you to do X, Y, and Z. But the final kind of step in the analysis is that modification or those modifications you made to your services had a more than nominal impact on your trade or business.
Right.
So how did going remote have a more than nominal impact on your trade or business? Well, you could say a lot of things. I mean, this is where you really have an opportunity to sort of define what your trade or business is. And the counsel we give to churches is, if you can, reach back to either some denominational documents, some values documents, some kind of core principle documents that relate to the gathering together and why that is so important for you theologically, why that's so important for you historically, and why that has to happen, because that will be the way that you sort of get into that. This is having a more than nominal impact on our trade or business, because our trade or business is having people get together physically.
That's right. That's right. Good stuff. Hey, here's another one, goes down in the weeds a little bit. We have a child development center at our church that shares our tax ID. Would we be able to file for the credit for just the church staff, excluding the CDC staff? And if they determine they are eligible at a later date, could they file separately? So they're all under the same tax ID.
If they're all under the same tax ID, then they would all need to file together.
That's where I thought you were going to go with that answer. I don't think you do those separately because they're all going to be on the same 941, right?
That's right. That's right. And here's the good news about having kind of two, not entities, but two types of business operational centers under one EIN. You kind of have a choose your own adventure there. So let's say that the CDC did not have a suspension, but the church did. Well, then you could argue that a more than nominal part of that EIN's operations was suspended. And therefore, the entirety of the organization, provided it's a small employer, we need not even talk about small employer versus large employer, but provided you're a small employer, meaning that you had less than 100 full-time employees in 2019 for 2020 credit, or less than 500 in 2019 for the 2021 credit, which I think would encompass most of the folks on this call. Then you would be able to claim all the wages for both the CDC and the Child Development Center and for the church, provided they're not ministers.
Yeah, I think in the state of Georgia here, we actually had, so the two separate operations. You've got the education component in the state of Georgia. I believe I'm saying this right. I believe some of the counties, their states of education, held the regulations in place longer than even the governor had there. In which case, like you say, you could choose the longer eligibility period under the school section of it, and maybe even have a better chance of getting some money back there. So
that's right. That's right.
All right, boy, I'm telling you, people, we will not get to all of these. Let me just tell you, we will not get to all of these, but these are great questions. So there is one. Where is that one? We are a mission agency. Can I include salaries for overseas employees? The PPP would not allow that.
And the ERC would not allow that either. So yeah, that's a really good question. And it's one that I get often from missions organizations or just international relief organizations that do a lot of work outside the States. But yes, this needs to be for stateside qualified wages for stateside employees.
Pretty simple one right here. Deadline. When's the deadline to file for all of this? So
you got some time. That's the good news about the ERC. So the only real deadline that exists here is the normal deadline for filing amended tax returns, which is 3 years from the original due date of the original tax return. So let's do just a quick example, Jim. So if you're trying to file for, let's say, Q1 of 2021, then the 941 that was due for Q1 of 2021 would have been due April 30th of 2021. So you have 3 years of that date to file your 941X. So you have until April 30th of 2024. So the house isn't on fire, but when it comes to that back-end documentation, where you're saying, here's the timeline for the modifications we made. Here's how long that timeline lasted. Here are the governmental orders. I mean, it's becoming more and more difficult even to find the governmental orders online because some of the states and locales are removing those. And, you know, I wish this were not true, but memory does not get better with age. And so trying to remember, okay, when did we cancel services? When did that happen? And how long did that last?
Right.
Like, you know, those people may have left your organization that were there in March of 2020. So that's why I usually say, yes, the house is not on fire, but your brain's not going to get much better between now and 2024. So do it as soon as you can. Get that back-end documentation together at least to substantiate your eligibility timeframe.
Love that. I love that question. Love that question. I love your explanation right there. Okay. So we have several people that are asking a similar type question. We have covered this, but I want you to go back. Here's the question. Can you go over the pastoral wages again? Is it only the housing allowance, a portion of their wages does not qualify, or is it their entire wage? Go back through that again, because we have like 5 people that are asking a similar type question there.
Yeah, that's really important. The way that the IRS and Congress talk about what kinds of wages are going to be qualified wages is that it explicitly excludes any earnings from ministers who are ordained, commissioned, or licensed ministers and who are receiving compensation for ministerial services. So this excludes both the housing allowance and your traditional compensation from the ERC qualified wages. And again, we're not entirely sure why this is the case. We used to think it was because, you know, you're not contributing to Social Security tax, which this is at its beginning, it's a Social Security tax, payroll tax credit. But the fact of the matter is we're not entirely sure why that's the case. But yes, it's both housing allowance and traditional compensation for ministers that must be excluded.
Yeah, and I think, Chris, I think the point here is that on most staffs, that number of people is fairly limited. If you had, you know, like 12 FTEs, I mean, you probably only have like 3, maybe 4, probably more like 3 that would be considered ministers under that. So you've got 9 people who would be eligible for wages. It wouldn't take very long for you to get to, you know, $7,500, $100,000 worth of ERC credits with that.
Well, that's right. That's right. And a couple things to keep in mind too is that you can include not just full-time employees, but part-timers, your nursery workers who work like 3 hours a week. You can throw all their qualified wages in, and also you can include qualified healthcare plan expenses. So if you've got some folks who they're not really getting close to that $10,000 per year in 2020 or $10,000 per quarter in 2021, throw in some qualified healthcare plan expenses because those are includable too. The ceiling of $10,000 still exists for all of that together. But I've seen organizations that have been able to get to that $10,000 with throwing in the qualified healthcare plan expenses. Yeah,
good point. I love that point. Okay, so several people asking this. We've sort of covered this, but I want to go back over it again. There's several sort of related, but this one is a really good statement of what I'm seeing from several people. Our state did not mandate churches must shut down, but strongly encouraged it. We followed that guidance and shut down. Will that qualify as a governmental order?
Ooh, this is tough.
I'm putting you on the spot, buddy. I'm throwing you the hot potatoes right here at the end. That's a hot one. I know it is.
You know what? I figured this day would come, Jim. I figured this day would come. Yeah, this is something where churches really wrestled with this. Yeah. The fact of the matter is that you have to look really closely at the governmental orders and also take a look at any other ancillary guidance you can find. So if your county has any kind of particular interpretation of the governmental orders, take a look at that. Because I was talking with one Illinois church, and in Illinois, something really strange happened. So between March 13th, 2020, you know, the day when many of these governmental orders were promulgated.
D-Day.
That's right. That's right. It was Black Friday. Yeah. So March 13th, it was Friday the 13th through, I think it was May 27th. Illinois had some strong restrictions on churches, on houses of worship. But many of these churches decided to sue the governor for those restrictions. And at the end of May, the governor said officially and made a very grand pronouncement that he was changing, they were changing all of these restrictions from requirements and shalls and do nots to recommendations. Mm-hmm. And so a lot of the Illinois churches were like, well, is that really a thing? Is that, you know, are these really just recommendations, or are these, you know, really restrictions in disguise? And so I had a few Illinois churches that were like, we just don't really know. Yeah. At the end of the day, the way that I looked at that Illinois case was, since the governor made such a grand pronouncement of these being recommendations and not requirements, it's going to be very difficult to say that this was what's called an appropriate governmental order. That's because right. it was fairly out there. There's lots of news pieces. The governor, came out and was very explicit. And on the church-based guidance, it said guidance, recommendations, that sort of stuff. However, some governmental orders were not as crystal clear, where it didn't seem like there were that these were recommendations, but they seemed like they might be requirements, and they couldn't really tell. So this is where people love lawyers. And I have to say it depends. It depends. You've got to look at those governmental orders and see, is there any kind of room of daylight between the interpretation that it could have been a recommendation, which means that it would not be an appropriate governmental order, or could it have been interpreted as a requirement, which would put it in the category of appropriate governmental order. So it really does take you taking a look at those things.
Yeah, good counsel there. That's a tough question to answer, because I know we're like, we are way out in the gray zone when we're dealing with that one, because to your point, it's just like, what we know is the fact that Dr. Fauci may have come out on a Friday and said, hey, if I were you, I wouldn't have people get, that's not going to be enough.
Correct.
You're going to have
Correct.
very specific local, if CDC had guidelines that were in place at the time, if your state had guidelines, if your county, if your city, any of those would apply. And, there is a question here. Is there a way to look up government regulations and mandates by state? Well, there's not a clearinghouse out there that I know of, unless you know of one, Chris. You're going to have to just Google it by state. State of Georgia, Governor Brian Kemp, COVID restrictions or something like that, and just go read through all that. And then what you do is, when you find the one that you're on March 13th, he said this, and that went into effect for 9 months. Print that out, put it in your work paper file, right? Yep. And then on October 1st, he extended that through the end of the year, or whatever he did. Print that out, put that in your file. That is a government order that says thou shalt not. Right. And in our state, it was pretty clear, thou shalt not. He relaxed some of it later on. But even then, the church gathering restrictions were much more stringent than even the restaurants and other things. So you could make the case. So print those things out. Anything that you can find that says under a governmental order, put that in your work paper file, because if you get audited, that's what you're going to hand over to the IRS and say, this is the basis on which we relied to be able to claim these things. Anything else you want to say on that one, as far as where to look all that up?
Yeah. So there is one website, but for some reason I'm not entirely sure which website it is. But I think it's if you were to Google state-specific COVID-19 governmental orders or something like that, then you might be able to find some kind of clearinghouse that gives you hyperlinks and that kind of stuff. But here's a caution. Some of these hyperlinks are dead, because a lot of these states have decided to remove their governmental orders from their state website. And so you might need to go to your state-specific website to sort of look around and see, okay, where are they putting the governmental orders now, the executive orders, and that sort of stuff. I saw briefly on the chat of does a county order work? The answer is yes, a county order does work.
Yes, it does. That's right.
Absolutely.
Good stuff. Hey, so a couple of minutes, and I think we've covered this, but maybe didn't spend enough time there. Is there a FTE limit? Does it to the number of people that can be on payroll?
So really quickly, the short answer is that's not an FTE limit, but it is a full-time employee limitation for the purposes of what the definition of qualified wages is. So that was a kind of a long response, but here's the scoop. Take a look at your 2019 average number of employees, average number of full-time employees. These are folks that work 30 hours a week or more, or 130 hours a month or more. And what you're going to do is, it's very similar to the way the Affordable Care Act number of full-time employees works. If you have folks who actually have to do that, you're going to take January of 2019, the number of folks that had 30 hours a week or more, 130 hours a month or more, and put the number at the bottom. Do that for February, March, on down through December. And then you're going to add those numbers up, divide by 12. That's your average number of full-time employees for 2019. And that's going to be your base number, okay? Then you're going to look into 2020. And for 2020 quarters, if you had more than 100 average full-time employees in 2019, then your qualified wages are going to be pretty limited. It's going to be limited to those who you paid and they weren't providing services, or you paid them full-time wages and they only worked part-time hours. And so that's really going to diminish your qualified wages for 2020. But then flash over to 2021. For 2021, that number goes up to 500 or more full-time employees, which I seriously doubt whether there's many people on this call who reach that amount.
Wouldn't think so.
And so, that number is going to be really important, but it doesn't mean that you're kicked out of ERC eligibility, but it means that your amount of qualified wages is going to be significantly diminished.
Yeah, good response. Good response. A quick one, Eva. I can take this one pretty quick because I actually know the answer to this. And what about contracted employees 1099? The answer is no, because they're not on your 941. So there's no reason, there's nothing to be recovered there. Here's a really good one down in the weeds a little bit. This is obviously from someone in an educational institution. For a religious college or seminary where most faculty, teachers, or pastors at the college seminary, would they need to be excluded as having received compensation for ministerial services? See, it's 5 minutes before we wrap up, and I saved a really tricky one for you there.
This is a humdinger.
Yeah, it is a humdinger, because I think I know where you're going to go with your answer, but I'll let you go there first.
Well, so this does happen, Jim, right? Like
it starts with it depends, right? Doesn't it start with it depends?
It starts with depends. That's right. Oftentimes, you have to think through what type of minister are you talking about. Right. So when we talk about the ministerial exception for Department of Labor rules and that kind of stuff, that's not the animal we're talking about here, because that's a very loose term. Not anyone, but many people who have just the smallest amount of ministerial services as part of their tasks can fit into that definition of a ministerial exception for Department of Labor and labor rules and that kind of stuff. But if you're talking about someone who is a ordained, commissioned, or licensed minister, and more than the majority of their activity is ministerial in nature, and they're getting paid for that, then that's someone who you're really gonna have to put a spotlight on and take a look and see, okay, are they, let's verify that they're ordained, commissioned, or licensed, and then let's take a look at their actual tasks to determine, are we paying them for ministerial services? And if the answer to both those questions is yes, then it doesn't matter whether you're a church or a religious school or a grocery store. Like they're a minister who is being paid for ministerial services, and therefore their wages need to be excluded. So it's time to sort of zero in and really make sure, okay, are we really paying them for ministerial services, or the way the IRS says it, for services performed in the exercise of their ministry? Are they conducting religious worship? Are they performing sacred functions? Are they engaged in leading a religious organization? That kind of stuff is where you'll really need to probe a little bit deeper. So yes, it depends. And then that's the analysis you'd go through.
Yeah. I think a case could be made, Chris, if we just take that a little, extend it just a tad here. If you had a pastor who was exclusively teaching at the seminary level and not doing anything but that, I think you probably wouldn't have that's probably a rare animal, by the way, because most of the pastors that I know who teach at the seminary level are actually doing weddings, they do funerals, they'll preach and do guest preaching and things, which that's going to put you over into this category of being a minister as the IRS defines it. But if you only taught and that's all you did, I think there's a really good chance that you would not be excluded, because you would be seen as a really leading education type services, not ministerial type services. But again,
yeah, and I think there's some soundness to that. And remember, it's what you as an employer are paying that person for, right?
That's right.
If they happen to do weddings and they happen to do funerals and that kind of stuff, and someone gives them an honorarium for that, then that's not something you're really concerned about. You're really concerned about what you are paying them for.
Good point.
And if you're paying a pastor who is just dynamite at biology and they're teaching biology all the time, that in my mind is going to skew towards, okay, you're not really paying them for services performing the exercise of the ministry. But if they're a chaplain and they're working at your religious college or institution, then in that case, they're probably going to be a minister for the purposes of the ERC, and their wages will need to be excluded.
Yeah, good stuff. Hey, Christy, so we're right here at the top of the hour. We're going to wrap up here, and just let me mention our call to action. As I said at the top, we don't have any call to action for you to do anything with Generis or anything with CapinCrouse. This is our gift for you today. Your call to action is go find your money. You probably have some. And hopefully we've raised enough of the issue today for you to go back to your finance team, or if you use an outside accountant, whether you're audited or not, go to your outside accountant. There's a really good chance that they know the answers to this. And there's a really good chance that you have some tax credits that are out there just for the asking. Even some of you who asked the question about the PPP offset, I'm just doing the math in my head. And there would be some money available to you, even if you had to do that offset. It's not as much as you would have gotten, but it doesn't reduce it to zero in probably most of the cases. So go through the exercise of doing your computations, and the chances are really good. Even smaller organizations might have 50 to 100,000. And if you're larger than that, you might have $250,000 to $500,000 sitting out there. You do not have to be super large for it to get that big. If you had eligibility for most of the months during that period, and you've got your $5,000 credit in 2020, you've got your $7,000 credit in 2021, it could add up to a lot of money. And so that's our call to action today. Take what you've heard today, go back to your team, go back to your people, and determine, do we have money that we're eligible for? And then go get it, because it is yours for the asking. And as we talked about, may take a little while, maybe even after this webinar, it'll take a little longer. I'm anticipating all of you are going to file. So you're going to put more stacks in the IRS offices, but it's coming to you and you'll get it. And as we say, without even really doing anything but filing the form. So go find your answer. Chris, thank you so much today. You were spot on and so good, so lively with your answers and so knowledgeable. I thought a couple of them in there. I was like, wait a minute, I'm going to throw this over to Chris and see what we got. And you did a great job of thinking through some of those sticky situations. And I like where you ended up with those answers. So we've given you guys a ton of good counsel today. The replay, hope that helps you. If you're like, hey, what did he say about wages? Or go back and listen to the replay. And Christy, I think you've got a couple of resources you're going to send to them after the fact as well, right?
So let me go ahead and speak to probably the second biggest question on the call. Will there be a recording? Yes. As you just said, there will be a replay. We'll just need to get this edited a little bit, but we'll be sending that out to everyone who registered. And you would also be able to access this recording and our ERC infographic, which I'm going to go ahead and just drop in the chat one more time. In about a day or two is what we're looking at. So this is an excellent resource to go to your accounting team with, to the other team members, the other members on your team, and just share with them everything that we learned today, and slow down the recording and probably take some notes, because there is, I know, a lot of things said on the front end that were probably asked midway. But yes, and any other resources, Chris, Jim, if there's anything that you feel that would be an excellent tool to add into that follow-up email, I can go ahead and take those and send that out to everyone. But thank you both. Thank you for leaning in on this conversation. I know it can get a little sticky, so we're grateful for your minds and for the knowledge you've shared with us today.
We tried to not let it get too wonky today, and I think we succeeded in that. Chris, you were great at that, buddy. Thank you so much.
Well, I appreciate that. And I appreciate the tough questions. It would have been really awkward if I just bounced from the call. So that's why I stuck around and just answered the questions. It was a lot of fun being with you guys, for sure.
Good. Thank you so much.
Have a great afternoon.
Take care.
Bye now.